Hi to all. In this video, we will quickly calculate the incremental cash flows from operations. So one important thing is if we have the following uh, information, we have revenues, operating expenses, depreciation, and amortization. We have a marginal tax rate, capital expenditures, and additional working capital. So if we want to calculate this incremental cash flows, right, we are looking at EBIT or earnings before interest and taxes, and then we're going to multiply that by 1 minus the tax rate. And once we do that, then we will add back the depreciation, and then we will subtract capital expenditures, and we will also subtract an increments in working capital. Why increments in working capital? Well, if you increase working capital, it means that you're increasing somehow your current assets, or which means that you used cash to increment the current assets, or you are reducing your current liabilities, which means you are using cash to re- for repayment of some current liabilities, right? So we just simply use this formula. Now, why, and what we will see is what is earnings before interest and taxes. Let's calculate this. And this is just revenues minus operating expenses. And this can be considered net operating uh, profits, uh, except that sometimes non operating expenses or extraordinary expenses or extraordinary income items may uh, make some distinction here, but let's just not discuss that for now. And then let's just subtract the expenses from the revenues, and then we subtract the depreciation and amortization here as well. We do not subtract interest expenses in this calculation, so we keep that in, but we don't have this in the information either. So why do we subtract depreciation if we are going to add it later on? Well, because the next step, what we're going to do is EBIT multiplied by 1 minus the tax rate. So we need to subtract the depreciation expense so that we are then reducing the correct amount. So we are calculating the correct amount of taxes, right? Um, if we do not subtract depreciation, then we would end up paying more taxes than what the firm will really be paying. So now we do this times 1 minus the tax rate, which is 33%, and these numbers are all randomly chosen by Canvas. And then once we have done that, then we can get the incremental cash flows. So incremental cash flows here, we will get it in the following way. We already have this first component, then we need to add, which is earnings before interest and taxes times 1. Then we are deducting taxes basically. So this is the after tax factor. If we multiply this, we will end up with the earnings before interest and taxes, and then after reducing taxes, so we would end up with NOPAT, net operating profits after taxes. So then once we have this, then we will add back the depreciation because it is a non-cash expense. The only reason why we subtract it is so that the taxes are calculated correctly, but then we need to add it back because depreciation was never actually spent, or money was never actually going out of the company um, because of depreciation. So we add it back, and then we subtract capital expenditures. That's easy to understand. And as I have mentioned, we subtract increments or additional working capital. And there we go. So we have this incremental cash flows, the calculation of these incremental cash flows. Okay. So let's just make sure to look at the canvas. There is an interesting module where all of these formulas are laid out carefully and in detail, and you can just go over these formulas, and it will be straightforward to solve the different problems in the practice quiz or in the actual quiz. Thank you so much for your attention. I hope this was helpful.